Hello guys and welcome to another Divari video. Today taking an in-depth look at Tesla Incorporated, an American multinational automotive and clean energy company. I think you've heard of it. They make battery electric vehicles, stationary battery energy storage devices, and solar shingles for rooftops. Now, first of all, let's start with the valuation metrics. They have a free cash flow yield of 0.28% and a price to earnings of 117, so very overvalued. Their business metrics look also pretty bad, to be honest, for such a high valuation. They have a return on tangible assets of 6%, return on equity of 9.8%, return on invested capital of 5.8%, and current ratio of 2, which is a bit better because it shows very good short-term liquidity. Now let's go to Grant's valuation using their estimated earnings per share for 2025, a 9% projected growth rate, which I think is a bit high, and we get an intrinsic value of $39.42, which is way below the current market price. The discounted cash flow model is even worse, using an 8% growth rate, which is a bit absurd for a company that has halved its FCF in the past 2 years. With a 2% perpetual and an 8% discount, we get an intrinsic value of $28, which is much less than the current price. The historical multiples we can see for the past 10 years, the average P/E ratio was 84. They're trading at a trailing 12 months price to earnings of 109. As for multiples variation, I compared them to Ford, General Motors, and Toyota Motor, and other the great three car companies, and they got an intrinsic value of $15 based on the average of the multiples. Now for the output, we have the average of all these three, and we get an intrinsic value of $27, which is way below the current price. And of course, applying a 15% margin of safety, we get an acceptable buy price of $23.4. So, what is important to note here at Tesla? Tesla is being affected heavily by Elon Musk's involvement in politics, and the current outlook for Tesla is pretty bad. They've had a horrible quarter where their sales have decreased a lot in Europe, in Asia, and this is becoming a very big problem. Personally, even putting in an 8% growth rate was pretty hard for me to imagine, but if they manage to somehow recover and start growing again, then the 8% growth rate seems more realistic, but even then, their valuations look terrible. So for their DCF to make sense, for the valuations to make sense, they have to have a 15, I think, percent growth. No, a 25%. No, 30, 35, 40. So just imagine that they need to have a 40% growth rate in free cash flow with an 8% discount rate and a 2% perpetual so that their DCF even makes sense. So this is how bad Tesla is at the moment, how badly valued they are. So they're extremely overpriced. I do not suggest you invest in them. It does not make any sense, in my opinion. Now I know there are people that love Tesla with the Tesla bot or whatever with the robot taxi. Look, guys, the robot taxi was meant to come years ago and it still hasn't come out. And Tesla isn't even the leader in self-driving. I've been in Mercedes, which drive themselves, and they have a level higher in autonomy. I think it's level 4 or something, and Teslas are level 3. So this company is pretty much equal to trash. And people say that it is a company which is not in the automotive business, but rather in the tech business. Well, I would like to ask them where the money is coming from, since all of this free cash flow is not spectacular tech, it's just cars. After all, if their cars do not sell well, the free cash flow disappears. So this is a car business, and they must be valued as a car business, just like all the other companies, and they are extremely overvalued. They do not deserve this valuation. And the fact that they're overvalued can be easily seen in the fact that they haven't really grown their stock price in the past 5 years. So they, compared to the market, I mean. And the fact that they are very volatile in stock price, they cannot break the 400, $300 barrier that much, easily shows that they're overvalued and they're pushing the limits of their investors' desires, so to say. I don't think any rational mind believes this company is worth more than 1 trillion. This is not even worth 200 billion, but people usually are insane with their money. And if people love to invest in this company, so be it, but I make much more money from value investing, so do as you must. Of course, due diligence is the most important thing you can do, and everyone should do it. So if you find something very interesting at Tesla, a hidden gem, then you can invest. But for me, this is too expensive. To end the video, I'd like to talk a bit about our fee for today, ticker data. Ticker data is a tool that I use for to make this video. So you see this template here with the real-time financial data. Well, this is ticker data. It is in the link in the description below. I suggest you check it out. Also, it is pretty cheap. Do not forget to also check out my investing blog from the link in the description below, where I recently posted an article talking about the 2022 tech crash and how it relates to today's market overvaluation and possible popping of the AI bubble. I hope to see you in the next video. Bye.